Welcome to the daily stock review of Eli Lilly. Goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. If that sounds good, subscribe to come along. Who am I? I'm Jack. I'm an individual investor on the journey, just 2,500 hours in over the last 7 years. I'm sharing lessons along the way. Here's my investing process. Today I'll cover how I came across this stock and the 5-minute check to see if it's worth looking into further. These are the guys I learn off. They did pretty well for themselves over just a little while. By following the breadcrumbs they've left behind, we should be able to follow in their footsteps. And if you'd like the free investing resources which I had when I first started, you can grab those with the link in the description. Right, Eli Lilly. I came across this stock. There's a fair bit of hype around a couple of businesses at the moment, and this is one of them. So it's had a fair whack of price increase in terms of its stock over the last 12 months, going up 50% since pretty much this time last year. And that's pretty much it. Let's go and see if it's worth the hype. And the other question, is it a business that I would want to look into further for the mission of this channel? So what I'm looking for now is just the annual report. Literally type in Eli Lilly annual reports, have a look around for the latest. Already opened it up. And what I'm looking for is the financial statements. So I'm looking for these statement of operations. And what I want to do is, I'm looking for, has this business mastered its customer? So we should be able to see some revenue growth and see some reasonable margins in the business. We then want to see, has the business got a moat around it? So usually you can see that with the profit margins of the business. You want to see them pretty strong and healthy. And then you want to have a look at the management. So you can tell how management is spending their money and prioritizing where the money is going by a quick look at the income sheet, as well as mainly in the cash flow statement. So let's have a sticky beat. So you got revenue, 34, that's in millions, so millions and then billions. 34 billion, 45 billion, 65 billion. Whoa. Nice. So these guys are almost doubling every 3 years just in revenue. It's a really good sign. Cost of sales, 7, 8.5, 11. Research and development costs aren't doubling over that same period, which is good. Marketing, selling, and admin is increased, but they're not having to do as much for it to get that same revenue growth, so that's good. It means majority of that extra cash is going to continue to drop through the business. And we've got a net income. Oh, nice. So over this 4-year period, the revenue's almost doubled in 3 years. But because the costs haven't grown at that same rate, that means that the net income has 4x'd. So this is why looking at the numbers and understanding how it all works is great, because if we were back here, for instance, and we could see that trend, we could then forward estimate what that was going to be, even if the business only grew as it did, so 45 to 60, whatever the maths is for that increase, you'd still be able to work out that it's going to be close to pretty much a double. And we can see that most of these numbers through here are fairly consistent. They got a little bit of growth here and here, but it means most of that cash that they get here is just going to drop straight to the bottom line of the business. So that is an awesome trend. Now, over time, we'd want to be understanding in terms of what that is, the growth of this business. So is this going to be sustainable? Is it going to be something that they can do long term? How long are the products and services that they've got going to be relevant for, and things like that. All right. So let's have a look at the balance sheet. I really just want to look out for anything that's going to be any red flags. Total current assets 55 against current liabilities of 35, and 112 billion total assets versus, you're annoying, what's that, 85. So pretty good. Nothing really here. Liabilities, long-term debt 28 to 40 billion. So one thing to look out for there would be to keep an eye on that. What's this trend going to be long term, and probably going back a couple of years, and understanding what pardon me, understanding why they need to increase their debt so much. Is it just balancing part of the cash flow of the business, or because at the end of the day, debt, you got to pay it back and you got to pay interest on it. So that's just another hole in the bucket that you're losing cash out of. All right, let's have a look at the cash flow statement. We've got 5, 10, 20 of our net income, just solid numbers. Net cash provided by operating activities, 4.2 billion, 8.8 billion, 16.8 billion. So you can see here, it's literally doubling. 4 to 8, 8 to 16. So just like the trend above, we're seeing pretty much majority of that money come straight down. And we can see that, the numbers are pretty consistent. So that it is either a sign that we need to delve in and just make sure what we're seeing here is pretty good. Lots of businesses can fudge their numbers just to make them nice and smooth. The other one is, it can also be a sign that this business has much more smaller items, and so it's a lot and is very operationally and logistically strong. So they're able to maintain and be very consistent with inventories, receivables, payments, and things like that. So if a business is really well run, we would really expect, and has smaller, like many units for selling, that can be why. All right, so where's it spending all this cash? Purchases of property and equipment. So it is funneling a fair bit of that into growth. 3.8, 5, 7.8. So having a look into what they're actually growing here would be good and interesting on another deep dive. Purchases of in-process research and development. So that's another part where they're investing. So for me, I don't know the industry a hell of a lot, but for me, just reading that would be, okay, cool. Well, they're not necessarily buying entire companies and acquiring them. They might call it, all right, cool, we're going to buy research that is midway through its process, and we're happy that that research has lowered their risk for a failure. So it means it's got more of a potential for being profitable, or coming out with a profitable product that's valuable to the marketplace in the future. So spending a lot of cash there as well, which is a good part of the business for them. So maintaining their moat is here and here, which is good to see. Proceeds, so net change in borrowings, proceeds from issuances of long-term debt. Like, I don't know why. Repayment of long-term debt. Yeah, so Like, I don't know why you'd want to have more long-term debt, considering you can just buy and sell marketable securities just to maintain your cash float at the end of the day. Purchases of common stock. Oh, this is getting weirder. All right. So let's just summarize here. So the business is making about 16 billion. It's been about 8, 9, 10, 11 up here in terms of purchase of property, plant, equipment, R&D. Now it's got part of that money left over, which let's just call it 6 for the time being. It's paid a dividend. It's paid a dividend of 5, and it's repurchased its own stock, and used up more than the money and then the cash flow that they had. And then over these last couple of years, they've been buying long-term debt, and it's only grown their cash position by a little bit. So right now, part of their dividends and those share repurchases have just been done by long-term debt. For me, yeah, like in leverage is a tool. Like, debt can be leverage and used as a tool. But this doesn't make sense to me. Even with the business's huge growth rates, like well-run business, you don't bother touching the long-term debt. Even if you have a rosy outlook on the future, because what you've done here is you've just grabbed money and then you're going from Peter to pay Paul and paying your own shareholders. Oh, I want to keep paying them a good dividend. Oh, I want to pay and buy my own common stock back to help out the long-term shareholders. It just seems idiotic. Even if you get a low interest rate on these and you know that you're going to have the cash flow in the future to pay for it, you're then going to be back in this hurdle of paying the interest, paying the debt off, and trying to maintain or not pay these. So it's just getting yourself in a future downward spiral. So not a good sign, not something I'd really be interested in. Now, the business itself, is it worth the hype? Let's have a look. So we've got a PE ratio of 41. So it's priced in by the market of anticipating more growth in the business so that it grows into this. More of a normalized number is usually around like 15 to 25, depending on what that kind of business does, how good the earnings are compared to the revenue and things like that. That's kind of a region where we would expect it to kind of be normal or priced if it wasn't really growing and it was just pretty much getting same cash flow year on year. For this one, I think it will grow into that. Is it a business that I'd like to own or look into further? I don't think so. It would have been a really good value play looking back here a couple of years back and seeing the general trend and being able to identify that before other investors did. Has it still got some growth on it at the moment? Yep, I'd say it would. But I've got other investments that I'd like to spend my time doing the deep dive on. Do I think Eli Lilly will become a $100 trillion business in the next 15, 20, 30 years? Don't think so. It might. But that's my take on the situation. I think it's quite a mature company. It'll have a fair bit of growth for the time being. If you wanted to have a look and do the deep dive for yourself, have a look closely at the products and services that are seeing the growth, how long those products and services are. They usually have a intellectual property like time frame around, and things like that. And then have a think about what's the actual growth rate that we're expecting. Is it going to level out? Are competitors working in that market as well? Now, is it worth the hype? I'd say yes. Is it something I want to look into? Not really. Debt's kind of poo-pooed me off, and the fact that they're paying a dividend and buying stock back and doing those internal investments and then taking on significant debt as well is not something I'm really interested in. All right. Enjoy that one. If you guys are invested in Eli Lilly or you've got any questions, comments, things like that, drop them in the comments below. And otherwise, check out this next video because YouTube thinks you'll like it. Cheers.